IRS Form 4835, Farm Rental Income and Expenses. So we did a video on this form a couple years ago. We're updating it just because that form is the 2022 version. The IRS came out recently with the 2025 version of the 4835 form. It's not really the kind of form that you need to refamiliarize yourself with every year. But we're going to go over some of the things that might have changed and just kind of point out some common concepts. So before we get into the step-by-step in this form, I'll just kind of give some broad guidance. So this is a one-page tax form that's broken down into two parts. Part 1 reports the gross farm rental income based on production. And then Part 2 contains expenses from the farm rental property. And then down below at the bottom, this is what you would put in on your Schedule E. And then the next couple of pages are really instructions. So the purpose of this form is to report income from renting a farm out. So if you have a farm and you actively work the farm, you would not use this form. This would be if you have a farm and or either you own the farm as the landowner or you're subleasing farmland and you did not materially participate for self-employment tax purposes in the operation or management of this farm, then you would use this to report that rental income based on crops or livestock from the tenant. Don't use this form if you're a tenant. You would use Schedule F. Don't use this if you were a landowner that materially participated in the operation of this farm. You would use Schedule F as well. If you used this farm for rental, but you claimed a cash rent, then you don't need to complete this form. You would simply report the income on Schedule E and then take your expenses from there. Schedule E also would be used if you're using if you're an estate or a trust with rental income. You would report that in Schedule E Part I. And then finally, partnership or an S corporation with rental income in expenses would simply report on IRS Form 8825. So any of these other forms and schedules that we mentioned here, we'll put links to the resources we've created on those forms and schedules in the show notes. So if you're married, you could possibly be considered as what's known as a qualified joint venture. So that would entail a married couple filing a joint tax return. And if they each materially participated as the only members of that jointly owned and operated farm rental business, then they can elect to make this taxed as a qualified joint venture instead of a partnership. This election, in most cases, should not increase the total tax owed on the joint tax return, but it would give each spouse credit for Social Security earnings on which retirement benefits and Medicare coverage are based. So if you and your spouse make the election but you did not participate, then you each can file a separate Form 4835 to report your share of farm rental income. And then I think that's about it. We'll get into a little bit more detail as the instructions mandate. So we're just going to go ahead and put John and Mary Doe. So let's just say that John Doe has Social Security number. If they had an EIN, they would then you would put it here. You only need an EIN if you had a qualified retirement plan or if you're required to file in employment, excise, estate, trust, partnership, or an ATF, an alcohol, tobacco, and firearms tax return. So if this is simply going on to your Form 1040, you don't need an EIN. In line A, This question is asked, did you actively participate in the operation of the farm? So according to the farm instructions, you are considered to have actively managed or participated if you participated in making management decisions or if you arranged for others to provide services. So you don't have to be out there swinging a hammer, but if you're interviewing the contractors, that would be considered active participation. Management decisions that are relevant in this context would include things like approving new tenants, deciding rent terms, approving repairs or capital expenses, other similar decisions. You would not be considered active participant if your interest in the activity was less than 10% of all interest in the activity. So you have to be at least a 10% owner. Let's just say that they are. Now, in part one, we're going to talk about where you would get the kind of income, how it would be reported to you. So, line one, income from the production of livestock, produce, grains, and other crops. Under either the cash or the accrual method of accounting, you would report livestock or crop share rentals in the year that you convert them into money. So let's just say that this was $50,000. Line 2A and 2B have to do with distributions from co-ops. So those would be reflected on IRS Form 1099 PATR. So line 2A would be the total distributions. Line 2B would be the taxable amount. So let's say that there was $10,000, but only $5,000 was taxable. Line 3A reflects agricultural programs. So if there were other payments from agricultural programs, again, broken down into total and taxable. To mitigate any confusion, we'll just use the same numbers. In line 4, this has to do with commodity credit corporation loans. So in line 4A, this would be the amount reported and then forfeited. So the CCC loans reported, you would put the total amount reported here, then the forfeit amount, and then the taxable amount of that. So let's just say it was $10,000 and we had to forfeit the entire amount, and in this case we'll just say the entire amount was taxable income. Crop insurance proceeds and federal crop disaster payments. So in general, you would have to report crop insurance proceeds in the year that you receive them. Federal crop disaster payments are treated as crop insurance proceeds. But if you use the cash method of accounting and 2024 was the year of damage, there may be certain proceeds that you could elect to include an income in the following year. So you would end up checking this box, so this would reflect, so let's just say box 5A, we put in $10,000. Let's just say that box 5B, the taxable amount was $5,000. We're going to defer some to 2026. And then in box 5D, you would enter any amounts that had been deferred from 2024. So to keep this simple, we'll just say that there was nothing deferred from 2024, but there is going to be some additional income that we defer to the following year. In line 6, you would use this to show any income that was not previously shown on lines 1 through 5D. So this could include things like federal and state gasoline or fuel tax credits or refunds, stuff like that. So we'll just say that there's nothing there. We're going to add all of these up. So that looks like $60,000, $70,000, $80,000, $5,000 of income. So in part 2, we're going to go over the expenses. A lot of these are pretty straightforward. So I will kind of put placeholders in each of these columns in rows. So, and then I'll go back and just kind of capture each of them. So all I'm doing is putting $1,000. The intent is not to make this overwhelming. It's really to make sure that we cover the salient details so you can better understand it. Generally speaking, you're going to have some expenses that are related to renting your farm out. So the concept here would be to make sure that you're knowledgeable enough to apply the appropriate expenses to offset as much income as you legally can without going bananas. So there is an entire publication for reporting farm income. So that would be IRS publication 225. That's literally called the Farmer's Tax Guide. You can see a lot of clarification on specific terms like material participation for landlords or passive activities, stuff like that. So if you have any questions and those questions really aren't answered here, alternative places you can look would be the Schedule F instructions. A lot of the line by line instructions do refer to identical instructions located in Schedule F. So literally very similar concepts. We're just applying them to a different form because we're renting the farm out instead of being the owner and operator. So in line 8, that would be car and truck expenses. So generally speaking, you could attach the depreciation schedule. That would be IRS Form 4562. That would cover the car and truck expenses plus anything that was allowed for depreciation. So whether you take the mileage, the business mileage deduction, or you calculate actual expenses, that you could do that, and then whatever's allocated to the farm rental would be put in here. Line 9, chemicals. That's pretty straightforward. Different types of farms have different types of chemicals. Line 10, so conservation expenses. The instructions specifically state that expenses that you paid or incurred for soil and water conservation, prevention of erosion, or endangered species recovery can only be deducted if they are consistent with a conservation plan approved by the Department of Agriculture or a recovery plan that's approved pursuant to the Endangered Species Act of 1973 for the area where your land is located. So if no plan exists, then your expenses must be consistent with a plan of comparable state agency. So either a federal or a state program has to have the guidance that allows you to take that deduction. However, your deduction cannot exceed 25% of your gross income from farming. So whatever that gross income amount would be, you can't exceed 25% of it. Line 11, so if you needed to custom hire out some machine work, that would go in line 11. Depreciation in section 179 expense, if you didn't claim it elsewhere, then you would enter that in line 12. So, if you claimed car expenses up here, but let's just say that there's like farm building depreciation as well as some capital equipment, and there wasn't any other place to put that depreciation, you would claim it in line 12. In line 13, we're going to enter employee benefit programs other than what was on line 21. So on line 21, we look over and we see pension and profit sharing plans. So if you have a retirement plan or an ERISA, like a employer sponsored retirement program, you can put the expenses in line 21. If you set up like a health savings account or a cafeteria plan or some other benefit program, then the cost would go in line 13. Line 14 for feed, line 15 for fertilizers and lime, freight and trucking on line 16. Line 17 would contain gasoline, fuel, and oil. Line 18 would contain any other kind of insurance other than health insurance. So line 19A and line 19B contains interest expenses. So 19A would be whatever was on a mortgage, and then 19B would be any other type of interest. And so there could be a limitation. You would calculate any limitations on IRS Form 8990. That's the business interest limitation form. So now the type of interest expense does depend on, the tax treatment of the interest expense depends on what type of interest. So a home mortgage would be treated as differently from investment expense. So a mortgage, let's say that you owned a farm with a mortgage on it, and then you also have your personal residence on that same property. You would have to determine how much of that mortgage is attributable to the house and claimed on maybe Schedule A of your tax return, and then what would be the rest that you would put on IRS Form 4835 or Schedule F if you're working that farm. So, and you would need to make sure that you properly classify your expense so that it's deducted in the correct line of your tax return. So in line 20, we've got labor costs minus any employment credits. Line 21, we previously discussed that. If you rent or leased vehicles, then you would enter the business portion of that lease. But if you leased a vehicle for more than 30 days, you may need to reduce your deduction by an inclusion amount, and there's specific guidance in leasing a car in IRS Publication 463. That's the Travel, Gift, and Car Expenses publication. The rest of these are pretty straightforward with no additional guidance in the instructions, so we're going to kind of just cover these. Repairs and maintenance. So repairs and maintenance would be different from a capital expense because capital expenses are major pieces of equipment or buildings that are depreciated, whereas repairs and maintenance, those are things that kind of happen all the time. There would be a fundamental difference between replacing a piece of machinery versus having someone come out to do minor repairs or, like twice a year maintenance on that same piece of equipment, whether it's an air conditioning unit for your house or whether it's, significant, like tractor, maybe not a tractor because you have other costs that you can put in here, but, processing equipment, anything like that would be, that would not require an overhaul or a change in your basis. So generally speaking, minor repairs would not change the basis of that property. Lines 30A through 30G would be expenses not listed on another line. So you can, find examples of other expenses in the Schedule F instructions. We'll just put a placeholder that says miscellaneous expenses for $1,000. And now we're going to add all of these up. That looks like 3, 5, 6, 7, 8, 9, 10, 14, 15, 16, 19, 20, 1, 2, 3, 4, 5. Let's just call it $25,000. So that's what we put into line 31. We're going to subtract line 31 from line 7, and that gives us $60,000. So if the result of this is income, you would enter it here and then on Schedule E. let's say that this was a minus $60,000. We would go to line 34, and then we would have to determine if line 32 is a loss, then either all of our investment is at risk or some of it is not at risk. So at-risk rules may apply. For example, if you took out a loan that had like a stop loss guarantee, or if you had some sort of downside protection in case your farm doesn't work out, then you could be subject to what are known as at-risk limitations, meaning that you could only take a tax loss on a prorated amount of that. So let's just say that none of that applies. We will put links in the show notes to resources we've created on IRS Form 6198 just in case you needed to go over that. And then IRS Form 8582, that's the interest expense limitation deduction. So whether you check 34A or 34B, you would still need to complete IRS Form 8582 to determine how much of your loss you can deduct in the current year and how much has to be carried forward or carried back. So let's just say that we did go through all that and we can take the full deduction here. You would put that also on line 40 of your Schedule E. So whether it's income or a loss, you can put that on line 40. If it's a loss, you do need to jump through a couple of hoops to see if it's subject to those two additional limitations, the investment interest limitation and the at-risk rules limitation. So that's about all we have for this updated tax form. Again, not a lot of substance has changed, but we wanted to make sure that we got updated guidance out there and covered anything that was specified in the instructions. So as I mentioned, we'll put links in the show notes to the articles and the videos we've created on all the forms mentioned here or in our article. So if there's a specific form you're looking for that you don't see a link to, you can always just go to the website, www.teachmepersonalfinance.com, type in the name of the tax form, and the article should appear. You can also type in the Google search bar on our channel, and you can find the corresponding video. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.